Next question. Okay, all right, someone is based in the US. I'm based in the US and my company has offered me a transfer to the Australian subsidiary. I have the option of being tax equalized. What does that mean? Should I accept it? Well, so the tax equalizations means different things to different companies, and you'd need to speak to the payroll or I guess your line manager just to get the specifics of your company. However, generally speaking, the principle of tax equalization is that when you take an expat assignment, so an assignment outside of your home market, you will be no better, no worse off than had you stayed at home. So even though you'll be based in Australia, you'll be paid and your taxes will be calculated more or less. It's kind of like this esoteric kind of calculation, kind of gets confusing, but you should be no better, no worse off than if you had remained in your home market, if you stay back in the US. So it tends to work to your advantage when you go into a higher tax jurisdiction like Scandinavia or Australia in your case, in that you are spared to some extent the pain of paying a higher tax bracket. But it often works against you if you subsequently get transferred to a lower tax jurisdiction like your Singapore or your Hong Kong, because then you are stuck at your home base tax rate and you don't get to enjoy the benefit that comes with being in a lower tax jurisdiction. So again, it varies by company and you may want to get professional advice. Bear in mind that the team within your company or the accountant that your company recommends, he or she works for your company, not for you. So it's in their best interest. Typically what we see is they would advocate what's best for the company and not necessarily what's best for you. So you may want to seek independent tax advice. And what firms such as ours, I mean, you don't have to come to us, just Google and whoever comes up and you feel comfortable with, you can have a conversation with them. And what we typically would do, what any tax team would typically do, is run a simulation. Okay, show me your most recent tax return. Let's assume that you got that in whatever the jurisdiction is, let's say it's Australia, and what will be your take-home pay to see if you're better or worse. Or what is the cash in your pocket, money in your bank account at the end of each month or at the end of each year. So by running that scenario, you can compare apples to apples and see whether it makes sense for you. I hope that helps.
Please subscribe, like, share, and comment below. Our books and upcoming events are available at htj.tax. Email us at help@htj.tax to engage us, to advise on international tax or business matters.